Stocks are feeling the hit as Russian troops move into parts of eastern Ukraine. The major markets fell yesterday, with the S&P 500 actually now in correction territory, so in other words down more than 10% from its recent high. Some investors may be wondering about whether they should be making some moves or where this is all going, and financial planner Ernie Burns joins us now with his thoughts. Ernie, good morning to you. I noticed the early trading, with the market opening now in about 5 minutes, the early trading implies that we'll have a little bit of a rebound this morning.
A little bit of a rebound, but with the Dow and the NASDAQ in correction mode, the Dow not too far behind. The big hopes is what's happening right now with Russia and Ukraine, what's going to basically topple off this market in a sense. So a lot of things have caused this. First, we've had COVID, which caused supply and demand issues. From there, we had inflation, and now the Russian event itself. And the Federal Reserve hasn't helped either. They haven't given any clear guidance on what they're going to be, how fast they're going to raise interest rates in the future.
And who knows how this whole thing will play out in Ukraine, for one thing, or how that would affect what the Fed might do.
That's true, in the sense of the Fed doesn't want to stop the economy, but Ukraine really does not supply anything to the United States, and Russia supplies a little bit of energy. One stroke of a pen, Biden could basically correct that, but they're not taking that even as an idea. However, what they can do in itself with these sanctions is putting financial pressure on Russia. However, Russia is a little bit more equipped than people think, so it's going to be a question about how far he takes this.
So for investors, the question is, if you're sitting there approaching retirement, what should you be thinking about versus if you're, say, 35 years old?
Well, if you're approaching retirement, you got to dial back on that risk. You're not 35 years old anymore. So right now, since the market's down 8 to 12%, you're buying shares cheaper in your 401k. But if you're approaching retirement in the next few years, you really have to dial back that risk. This money has to last the rest of your life. And with inflation at 7.5% and going higher, you really have to make sure that you have an actual financial plan. You just don't have a bunch of investments. You actually have a financial plan for the future.
Well, and that's the thing. When you talk 0.2% inflation, that means prices double, every 10 years?
Yes, sir, they do. And they have. If you think about a gallon of milk in 2008, $2 a gallon, now it's $4 a gallon today. A loaf of bread was $1, now it's $2.50 today. Things have doubled in the last 12 years. So therefore, if inflation stays in the course that it's doing, it could cause some issues. However, I believe by the end of the year, inflation is going to start settling down. Here's why I'm saying that. Because people are going back to work. COVID doesn't look like we have any variants in the United States. People are going back to work. The states are opening up now. Our economy is going to start booming again. That's going to cut supply and demand overall. It's going to release a lot of supply and demand, which will lower inflation by norms. By doing that, that should dial it down. I think we're going to hit about 8% inflation. Then it's going to start settling down. And by the end of the year, it should end around 5%.
In something that's at least a little more manageable. All right, Ernie Burns, we appreciate the time as always. Thanks, Ernie.
Thank you very much.